Hi guys, this is Aetherium Capital, the guy that manages around $400,000 in his long-term portfolio. So this is my returns for the public IBKR portfolio, and I'll be revealing some of my positions. So this public IBKR portfolio is currently worth around $60,000. It was worth around $35,000 about 2 months ago, but because of the recent crash, I actually added quite a significant amount of positions in the public IBKR portfolio. So this public IBKR portfolio is actually quite concentrated, but do not be surprised by the concentration because this is just a small portion of my net worth. So even though it is concentrated on an overall portfolio basis, it is actually not that concentrated. So let's look at the positions in the portfolio. As you can see over here, I have a significant amount of money in Google ASML. And the reason is because I believe that these companies over here are quite undervalued and they are high quality companies that deserve to be owned in a large concentration. So let's look at my investment thesis and what is the reason why I added these companies. So first of all, as I mentioned earlier, in my public IB Care portfolio, I added around 35,000 to $60,000 over this month. And everyone knows that I do own a Mumu portfolio that's around $250,000. And I also have a personal IB Care portfolio that's around $112,000. So for those of you guys who are saying that, who is this guy? He doesn't manage a lot of money. What does he know? I'm just here to show you guys that you are wrong. And I do have a lot of money invested in the markets. And that's the reason why my investment decisions must be as correct as possible so that I do not lose as much money as the market. So let's look at my investment thesis. So the investment thesis is quite simple. It is simply to buy high quality companies at good prices. So for example, let's say Palantir. Palantir is quite a quality company. However, there is no way in hell that I'm paying 300p for a company regardless of how good it is. So the key word is to actually buy high quality companies and it must be at good prices that are close to the intrinsic value. So, what I want to find in a business is also the moats of a business. So, a moat of a business is basically described as the competitive advantage of a business and the business's ability to actually retain its profits for a long period of time. So, in a capitalistic society like USA, if you are making a lot of money, there will be a lot of competitors trying to take a pie, a portion of that pie. So, you must have some type of competitive advantage that prevents your customers from switching to others or makes you stand out. So, for example, is high switching costs, unique products, network effects such as your Meta, as well as economies of scale such as TSMC. So, let's look at how I identify high quality companies. So, high quality companies, they have high gross and net margins, high return on invested capital, low reinvestment rate, as well as good top line and bottom line growth, as well as good capital management allocation. So this might appear to be a huge chunk. Let me digest it for you. So high gross and net margin basically means that the company is extremely profitable and is making a lot of money. And this is usually found in your technological companies that has a net margin of above 20%. Return on invested capital measures how well your capital is being allocated. So when you have a higher return on invested capital, what it means is that, for example, if I have a 30% ROIC, when I put in $100, I will get back $130. So a high ROIC is extremely important for your compounders because if the compounders do not have a high ROIC, it means that they are actually investing in value destructive projects that will not benefit shareholders in the long run. Low reinvestment rates refers to a low capital expenditures. So what this means is that the company does not require you to constantly invest to grow. So an example of a company with low reinvestment rate is actually your SPGI, and a company with high reinvestment rate is actually your Tesla. So I'll give you examples and the ratios that I use. Top line as well as bottom line growth refers to your revenue as well as the fundamentals such as earnings per share and your free cash flow. So good capital allocation is dependent on the management and your belief in the management. So let's look at some examples of companies that are good and companies that are poor. So let's look at a poor company first. So a poor company is one where it is extremely unstable. And as you can see, the earnings per share growth grew from 0.21 explosive growth, taper off, and it drops off. So over here, EPS, it is not consistent And this is something that I do not really like. So I prefer finding companies that are extremely consistent and predictable. And as you can see, the margin of Tesla is extremely low. It was initially at 10% and it increase and declines to 7.3%. So let's look at Microsoft instead. That's a very good company. In fact, Microsoft is a perfect example of a great company, a high quality company. So let's look at the EPS growth of the company, as you can see over here. The EPS grows steadily year on year, and even during the 2022 recession or the 2022 crash, it was still up 0.31%. So this over here is a perfect example of a high quality company where there is consistent earning per share growth and free cash flow per share growth. So let's look at the margins as well. If you look at the profit margins of the company, it is at 30 plus percent. This is absolutely amazing, and this is far better than Tesla's 7 to 8%, as you can see over here. So let's look at other ratios that I mentioned earlier. So the ratios that I mentioned earlier, one of it is actually your return on invested capital. So if you look at the ROIC of Microsoft, it is consistently close to 20% over the 5 years. So this is what I want to see. I want to see consistent companies with good capital allocation strategies. And let's look at Tesla's ROIC. This one over here is a headache. So let's look at it. The ROIC, as you can see over here, at 10%, 18%, 8%, 5%, 6%. I mean, these type of returns from the capital allocation strategy is not good. And these over here are value destroying allocations and projects. So over here, Microsoft is obviously the better company and is also trading at a much cheaper valuation than Tesla. So even though I do own Tesla for the story, I believe that Microsoft is the one that's likely to outperform in the long term. So let's go back to the previous thing where I said about reinvestment rate. So to calculate the reinvestment rate, we have to look at something that is known as the capex to operating cash flow. So this is an example of a quality company, and as you can see, it spends only around 2% of its operating cash flow on capital expenditures. However, going back to Tesla, we find out that Tesla actually spends over 58% of its operating cash flow on capital expenditures. So what this means is that Tesla requires constant reinvestment into the company, whereas companies such as S&P Global doesn't require as much. And in the long term, usually it is these companies that do not require much capex that outperform. So for those of you guys who have no idea what S&P Global does, it is a credit rating company that has been here for the past 100 years. And if nothing goes wrong, it is more likely to continue for another 100 years. So low capital expenditure businesses will enable you to actually stay in the market for a long time because you do not have to constantly reinvest your cash flow into projects that may blow up or go wrong. I hope you guys found this video useful and all the best in investing. And if you like this video, do consider subscribing.